Does the end justify the means if we scored big in a trade as a day trader? I would strongly argue no, and actually go even further. Dumb luck is one of the most dangerous things that can happen to us in trading. Why? The reason to this can be explained with one of the most prominent behavioral biases, the outcome bias, or also called disparity fallacy or equity fallacy. To fully understand this and the toxic effect it can have on our trading performance, let's break it down step by step. First, let's understand what is the outcome bias. Second, analyze how it can affect our trading decisions with some examples. And third, discuss what we can do as traders to countermeasure the effect and build a system of better trading decisions. If you're interested in trading psychology and common behavioral biases, which explain a large extent of our oftentimes destructing trading behavior, feel invited to also check our other videos on the gambler's fallacy, the blind spot bias, the pessimism bias, or also Daniel Kahneman's prospect theory. I'm Jonas, co-founder and CEO of Hoc-trade. Let's get started. What is the outcome bias? To put it simple, the behavior of judging the quality of a decision only based on its outcome is what we call the outcome bias. We can witness the outcome bias in nearly all aspects of life, whether it is medicine, sports, at work, gambling, or trading. When looking at other people, we have limited visibility on their decision-making process, whether that decision was actually good or bad. Consider a heart surgeon who decides to perform a risky surgery. However, sadly, the patient dies during the surgery. It is easy to judge the surgeon's decision as bad, but what do we know about the background, the probabilities of success if doing the surgery versus when not? It might be that a highly unlikely event happened during the surgery and that the overall decision to perform the surgery was indeed the best decision at this moment. What effect might this behavioral bias have though? To better understand it and which type of judgments are actually critical and dangerous, let's have a look at the following process outcome matrix. A good process would refer to a rational decision based on probabilities, choosing the decision which provides a favorable risk-reward outcome. On the other hand, a bad decision refers to a decision which does not weigh the probabilities of success. The two dangerous combinations, especially for trading, in this matrix are dumb luck, so having a bad decision process, however still receiving a good outcome, and bad break, so having a good decision process, however receiving a bad outcome. Before deep diving into this, let's first of all understand a bit more how easy we are to misjudge due to the outcome bias and how common it happens. Annie Duke gave a great example in her book Thinking in Bets, which refers to poker players. Poker is a very good example as playing your hand is mostly based on probabilities with an unknown outcome at the time of decision making. We have a great poker player that strategically weighs the decisions based on probabilities, competing against a player who does not. Consider it as the good decision-making process versus the bad decision-making process in the matrix we just looked at. Now, if those two players compete for 8 hours, the likelihood of the good player losing is still over 40%, even though he or she did all the good decisions. As viewers of the poker match, we only see those snapshots of 8 hours and see that the bad player is winning. We are likely to think that the bad player is actually good and vice versa. Of course, assuming unlimited capital and a long enough playing time, the chances of the good player to win would approach 100%. However, in reality, we barely have those kind of situations. So far, we have discussed the outcome bias in situations where we observe other people's decision. However, the outcome bias is not limited to this. We might follow, trust, bet on, or take advice from the wrong people, but it is oftentimes even more destructive when being victim to the outcome bias, judging ourselves. Why? Let's apply the outcome bias to trading and see what effect it may have on ourselves and our performance. Having understood the outcome bias, let's have a look at two common trading examples which I'm sure many of you have already experienced in a similar form yourself. Many of our trading decisions can actually be explained by the human behavioral tendencies we've discussed so far. In the first example, we have a trade which initially shows little price action until it is hit by bad news. As the price drops from the bad news, the trader is not willing to give up on the position, but decides to double down on the trade, entering a second position. After entering the second trade, the price starts to increase and runs into the initial take profit level, leaving the trader with a nice profit. Excited from the great trade outcome, the trader might conclude that he or she is great at news trading, stoked to have found an apparently effective trading strategy of trading the bounce back from a strong price action due to news. However, what has happened here? The trader experienced a dumb luck situation, as defined earlier in the process outcome matrix. Based on the trading system, the trader should have cut the losses, but instead doubled down on the trade. Moreover, this trader got lucky, creating a good outcome. A situation like this can easily lead the trader to think of having found a new profitable trading strategy, and the recent success justifies an adjustment of his current strategy. Little do we know whether the previous strategy was profitable or whether the new trading strategy will be profitable. Deciding on this would require much more data on a longer time frame. However, traders receptive to the outcome bias will not focus on the decision process, but the outcome. And in the given situation, the outcome gives a clear direction. The situation could be very different though. Consider this second example. The trader opens and then closes a trade in profit based on his or her trading strategy. After closing the trade, the trader witnesses how the price keeps increasing, creating a feeling of having lost this additional profit that could have been made in the trade. After a while, the trader decides to re-enter the position, seeing all this foregone additional profit. Shortly after, the price reverses, giving a loss in the second trade, completely offsetting the initial profit with the first trade. Therefore, the trader starts to question whether any of his or her decisions are actually correct and decides to double down, hoping to recover at least the initial profit. The price keeps dropping though, leaving the trader with a big overall loss and full desperation. Again, what has happened here? This time, we could describe the situation as having a bad break for our decision outcome matrix earlier. The trader even made a profit, and also the second trade entry may have been according to the trading system. An unfortunate development of the trade associated with a lot of pain led the trader to doubt their own system though, deciding to try saving the trade by doubling down. Again, seeing how the first trade could have made much more profit and seeing an initial loss in the re-entry justifies the decision for the trader to change the current system, as apparently the current system gives only losses. The initial system might be profitable, however, due to some bad luck, which is statistically meant to happen all the time in trading, the trader deviates from it. Based on the two examples, we can conclude that being receptive to the outcome bias in trading will lead to constant doubt about your own strategy and skills, as we associate a bad trade outcome with a bad process and a good trade outcome with a good process. Moreover, if the trader deviates from the current trading strategy due to the doubt or excitement from bad takes and dump lucks, the trader is likely to apply a much more emotion-based decision approach, disregarding the inputs set by the trading strategy and consequently, due to the missing guardrails, rather applying emotions as action triggers. Trading based on emotions will open ourselves up to many more behavioral biases with even more destructive results. Lastly, concluding from dump luck trades to apply a different strategy strongly increases the likelihood to follow strategies that are actually not profitable, thereby entering a doom loop of constant adjustments, confusion, pain, and ultimately, most likely, a margin call. However, of course, there are things we as traders can do to prevent or soften the impact of the outcome bias on our trading. Let's discuss those in part 3. Before deep diving in 3 countermeasures we can apply as traders, let's summarize in very short what we have to keep in mind as traders when dealing with the outcome bias. A good trade does not necessarily have a good trading outcome. And B, a good trade outcome does not necessarily mean we traded good. As a result, it becomes very clear that as traders we should detach our trading results from our trading strategy in the short term. Looking at single trade results has little to no correlation to how good or bad our trading strategy is. However, we are all human beings and it is very difficult to detach those two as we are wired to do so. Therefore, we need dedicated countermeasures to do so. The following 3 have shown to be effective for us and other traders we know. 1. Situational awareness. 2. Rigorous tracking and analytics. And 3. Reducing complexity during trading. Let's go step by step what those are. Situational awareness. If you've watched our previous videos on different behavioral biases and traders' countermeasures, you will be familiar with situational awareness already. By its nature, behavioral biases are unconscious. Therefore, we do not recognize their effect on our behavior until we are aware of them. By watching this video, you have done the first step necessary to start recognizing when you become victim to the outcome bias, thereby moving this bias from unconscious to conscious. You understand the bias, and the next time you think whether you should adjust your trading strategy or not, you may think about the outcome bias and challenge yourself whether the process leading to your decision was good or bad. This is the necessary foundation for every trader out there. Adjusting trading behaviors is never an instant process. It always starts with understanding, recognizing, and then step-by-step adjustments. Point 2. Rigorous tracking and analytics. The very best counter-argument against constantly adjusting our trading system and behavior is if we can see black and white what actually works for us and what doesn't. Before advancement in tools, we were rigorously tracking every single trade of ours manually in Excel or even on paper, identifying behaviors, listing our motivations and emotions during the trade, and try to match this with market indicators, volumes, or price levels. Luckily, nowadays we have automated trading journals and even more advanced behavior analytics software. All of our trading actions will be automatically tracked, analyzed, and we just have to check which strategies and behaviors are actually profit or loss making for us. As traders, we can easily deviate from our strategies if we are in doubt. However, seeing our decisions and outcomes based on hundreds of trades, how we would perform if closing our positions slightly earlier or later, doubling down on trades that are already in loss, or how we perform trading with or against the market trend, can give us as traders the necessary long-term viewpoint required to gain the confidence in our trading strategy and thereby easily identify a bad break trade if they happen. Of course, every beginning is hard and we need this large enough data set of historical trades in order to find those significances and gain this confidence. If we do not have this yet, we can either keep trading on a demo account or trade with such small position sizes that we prevent strong emotions from overtaking the lead on our trading decisions. Hoc-trade is one of those tools, which can be used for your tracking and analytics, and it actually tracks and analyzes many more behaviors compared to what is shown here. If you would like to have a free testing access to the beta version, feel invited to join our Discord server. You will get all the accesses there. And point 3, reducing complexity during trading. During trading, our brain processes a huge amount of data and new information. Every new tick of price quotes, news, analysis, our emotions, and much more. Naturally, we do not have much time during trading to make decisions, which fuels ourselves to work in ways that are naturally wired in our brain. As you can imagine, one example of this is the outcome bias. If we only have a very short time to make decisions, we may not account for the process, but use the shortcut to only look at the outcome. In order to give ourselves more time to make decisions, we should limit the complexity during trading as much as possible. This may include the amount of positions we enter at the same time, the amount of trading symbols we are following, the number of news websites we are tracking, the social media running, or whatever else takes some of your focus. If we really want to build a successful trading system, we can focus on one asset only during a specific time of the day, repeating the strategy over and over again. By doing so, we give ourselves the chance to build confidence and the data set required to judge its effectiveness. If our strategy and approach proving to be effective, we can slowly start to scale and thereby also increase the complexity again. Alright, let's quickly summarize. Working on behavioral biases is not an easy task, and most of the traders in the market will never do so due to its complexity and unconscious nature. At the same time, most of the traders are also losing in the market. The moment we accept that we, just like anyone else, may act based on known behavioral biases is the moment we can start working on them. For the outcome bias, we first need to recognize the moments in which we judge decisions purely based on its outcome. We build a solid database of our decisions and outcomes, thereby creating a reference point which we can confidently draw from. Last, we try to reduce the complexity in our trading as much as possible to give ourselves and our brain the most possible time to process information and do not act in pre-wired behavioral structures. If you are interested in trading and trading psychology, please leave us a like and subscribe to our channel. There is much more content coming in the next weeks. Thank you for watching, happy trading, and stay safe. Please be aware that we at Hoc-trade are no financial advisor. This video is for entertainment purpose only.